Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi. Welcome to another edition of What is Driving the Markets, where we discuss key events and address key questions on investors' mind. In today's episode, we discuss the drivers of recent surge in market volatility and its implications for investors. September was one of the weakest months this year for global assets, as global central banks, another pivot towards further rate hikes, raised the risk of a recession with another leg down for risk assets. Indian equities have corrected sharply over the last few weeks, with the Nifty index down 5.4% from its mid-September highs. The Nifty index ended September with a negative return, delivering negative returns in 6 out of 9 months so far in 2022. Domestic bond yields have risen sharply, with the benchmark 10-year Indian government bond yield up 32 bips, while the short-term yields have surged between 30 to 35 basis points since mid-September. Gold fell by 1%, paring its year-to-date 2022 gains to 4.5%, and the INR hit a new all-time low against the USD amid persistent trade deficit, foreign investor outflows, and strengthening USD. The DXY index, or a broad gauge of USD's strength against major global currencies, is up 17% year-to-date 2022. Towards the end of September, the RBI delivered its fourth consecutive rate hike in financial year 2023. The RBI raised repo rates by 50 basis points to 5.9% in its September policy meeting and reiterated its continued focus on withdrawal of accommodation to contain inflation while supporting growth. Further, the RBI kept its average inflation forecast for fiscal year 23 unchanged at 6.7% and revised its fiscal year FY23 GDP growth forecast downward to 7% from 7.2% earlier. Now, given this context, let's understand what this means for investors. Another upward shift in the outlook for policy rates, driven by a hawkish US Fed amid still persistent and elevated inflationary pressures, remains the central driver of volatility in markets. In our view, the near-term outlook remains challenging, and we highlight the key investor implications. Fundamentals remain strong for equities, but risks are rising. Indian equities have significantly outperformed its global peers. For comparison, the Nifty index is down 1.5% year-to-date 2022 as of end of September, while the MSCI Emerging Market and the MSCI World Index is down 29% and 26% year-to-date 2022 respectively. Indian equities continue to remain supported by the following factors. First, strong domestic macro fundamentals with economic indicators still signaling above-trend economic growth. Second, resilient corporate earnings cycle with consensus Nifty index EPS to grow about 16% in FY23. Both economic growth and earnings remains ahead of peers with lower downside risk. Third factor is the monetary policy environment, which is far less restrictive given current inflationary pressures. However, risks are rising as India's absolute and relative valuation to its peer remains close to historic highs. Investor and technical positioning are still elevated. Slowing domestic investor flows is another headwind for markets. Bond yields are likely to trend higher. Domestic bond yields have surged in September as investors reprice their terminal policy rate expectations higher. Further, falling India's interest rate differentials with major peers and waning optimism on India's inclusion in global bond indices had waned on bond sentiments despite attractive valuations. In our view, the risk-reward for bonds has improved with an attractive yield on offer and bulk of the incremental rate hikes likely priced in. The one-year overnight index swap spread suggests market participants expect the RBI to raise policy rates by at least 50 to 75 basis points over the next 12 months. We expect the 10-year Indian government bond yields to trade in a range of 7.5% to 7.75%. The INR is likely to trade with a neutral bias over the coming 12 months. However, in the near term, which is 1 to 3 months, the INR is likely to be under pressure amid near-term USD strength and weak external accounts. The RBI has defended INR volatility by drawing down on FX reserves, and though it possesses sufficient firepower, even still, rising trade deficit continues to remain a concern. Lower commodity prices and light foreign investor positioning are tailwinds for the INR. Overall, market volatility is likely to stay elevated as central banks continue to signal an aggressive pace of rate hikes to enhance their inflation-fighting capabilities. Risks of a more prolonged recession are rising. diversification remains key and investors could look to diversify through a preference for large cap equities over mid and small cap equities. Second, preference for themes such as India's investment revival and broadening value rotation that benefit from a rising yield environment. Third, preference for short maturity bonds given their lower sensitivity to rising interest rates. And fourth, allocation to gold as it acts like a portfolio hedge against inflation risks and equity market volatility. At this point, I'll take a pause and thank you as always for listening. If you find this podcast useful, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.